De-risking is the process of lowering the risk profile of your investment portfolio. Traditional portfolio managers adopt a number of well-established practices that are capable of dramatically adjust the investor risk exposure. This practice assumes that you are diversified in a number of liquid securities and that your intention is to lower the risk and therefore the potential returns of your portfolio. Well, someone starting investing in early stage can ask sometimes, what about de-risking my company's portfolio? Do I have the same luxury as in the financial markets? Or are there any methodologies that allow risk manipulation? In general, we are faced by two main intrinsic problems. One is about risk measurement, and the second one is about liquidity. First of all, early-stage investors have an endemic problem, and that is the one of risk assessment. Data-driven portfolio managers can use quantitative methods to compute and compare the risk exposure in a very systematic manner. Modern portfolio theory, for example, uses asset allocation, diversification, and rebalancing to structure the optimal portfolio, given a level of risk. Beta, standard deviation, Sharpe ratio, and value at risk or VAR are the gold standard for risk assessment. The problem here is that early-stage investors cannot really count on any singular reference metric. The lack of data does not allow any traditional statistical tool. The risk assessment process takes more a qualitative nature instead of quantitative and relies generally on a number of soft proxy indicators, to say the best. There are a few articles that are written about the kind of risk assessment tools and proxy indicators, and they usually include something like technical risk, market risk, team risk, financing risk, etc. In addition, for each element of the list, every investor has its own interpretation that is based on a particular investment thesis. So given the wide variety of industries and investors, the number of definition of risk is to grow geometrically, unfortunately. So early stage investing is highly risky, and it is even more frustrating as you cannot say by how much exactly it is riskier compared to another asset class. Great. The second problem that the early stage investor is faced with is the fact that early stage VC and PE investment are highly liquid. There is no market where you can exchange your equity position in what you think can be the next Uber. This is the nature of this class. It is a long-term, high-risk, illiquid asset. The upside can be great, but the probability is slim. It is important that someone that starts investing in early-stage companies is always well aware of it, and that he knows that he can digest this fact in particular. However, sometimes there is a way out. So occasionally, as the business grows and the VC and PE industry takes an interest in one of your beloved portfolio company, they might offer you to purchase your stake. This is referred as a secondary market operation. And this is a possibility, but an early stage investor, of course, cannot realistically rely on this to happen. But let's take a step back and think about the question itself that people are asking. Should you de-risk your early stage portfolio? The mere fact of asking this question kind of misses the point of early stage investing. The purpose of investing early in what the investor assesses as a high potential company is to ride the growth, actively help, and ultimately reap the long-term benefits. I can see how some people might argue that you should not de-risk at all, but actually you should take more risks. There is, I believe, a strong argument in which alternatives, such as early equity, can benefit your overall investment portfolio. This latter must include other asset classes that can actually be manipulated to reach a desired level of risk. I think it makes sense to talk about de-risking as a general portfolio strategy, but it does not make much sense thinking about de-risking if we refer exclusively to a portfolio of early-stage companies. So here we can draw a few conclusions. Financial markets make us think of risk in terms of volatility. We rely on historical data and assess the likelihood on how future performance will be. This is a quantitative approach that benefits from the deep advancement of statistical manipulation of data and that has provided a solid and insightful foundation of risk management. Early stage investing, on the other hand, requires a different notion of risk. This cannot be captured in financial models, ratio, or clear-cut procedure. It seems closer to a scenario analysis. Each business in an early stage portfolio can go terribly bad for a number of reasons, and the overall riskiness of the early stage portfolio depends on how well I have selected my companies. So only an educated sense, and not a measure, of risk can be captured by a deep awareness of those scenarios.